Greetings, my name is Ted Hicks. I'm the founder, CEO, and Chief Investment Officer for Hicks Associates Wealth Management. Today is Friday, December 2nd, 2022, and this is our monthly market monologue where we're going to provide some updates on the stock and bond markets as well as looking at some economic data. But before we dive in, I want to stop and encourage you to make sure that you've connected with us on Twitter. If you are on that platform, you should see the handle on the screen now, as well as Facebook. If you're there, please join us on those platforms. Obviously, if you're here on YouTube, please make sure that you have hit the subscribe button, and that should be right below this video. Just toggle that switch on to make sure you get our regular updates. That said, we're going to start by looking at some economic data, and let's look at GDP. Recently, the Bureau of Economic Analysis revised third quarter GDP up. They're now saying that the economy expanded by 2.9% in the third quarter here in the United States. Now, this follows the first and second quarters, which were both negative. Now, remember, most textbooks define a recession as 2 consecutive quarters of negative GDP. So we certainly had that. Now we have positive GDP in the third quarter. Now, let's look to see what do we think might be the stats for the fourth quarter. So on the screen right now is the projection from the Atlanta Federal Reserve. Their projection for fourth quarter GDP is this green line. Their current projection is coming in at about 2.8%. Their high for the quarter was 4.3%. But again, right now they've got the projection for fourth quarter GDP to be 2.8%. Now, two things. Number one, that's a positive statistic. So again, that would be 2 quarters of negative GDP, first and second quarter, followed by 2 quarters of positive GDP, third and fourth quarter. However, look at the blue chip consensus estimates. You can see that the consensus estimates of other economists is still fairly low. Now, we also can look at some data that I took from the Conference Board. The Conference Board is a global economic think tank. And so they've got projections for the fourth quarter GDP to be negative 0.5, and then first and second quarter of 2003 to also be negative. So to give a little bit more color, I want to call attention to some articles on the Conference Board's website. You can read the full article for yourself. I've got the website address listed, conference-board.org. In particular, look at this title, Imminent U.S. Recession to be Followed by Slower Economic Growth. That should not be a surprise to anybody that has been following our channels all year long. We've been talking about this for quite some time. Here's another one, same website. The global economy is weakening rapidly, with the U.S. and Europe forecast to experience recessions in the very near term and China to suffer significantly weaker growth in 2023. This should not be news to those who have been following our channel. We've been talking about this all year long. One of the ways that we've been looking at this is the yield curve. As a reminder, the yield curve is simply the difference between two different yields. So in this case, we're looking at what is the yield on a 10-year treasury minus the yield from a 3-month treasury. And when that answer goes negative, that yield curve is said to be inverted. And the reason this is important is the research shows that when this yield curve goes inverted, when it goes negative, that forecasts a recession. And on the screen, you can barely see this gray bar on the left, and then here's another one, and right in 2000, and then these are the recessions. And you can see that these yield curves go negative prior to the recession. This yield curve went negative prior to 2020, and it's negative now. Now let's zero in just a little bit more. And again, this is the same yield curve. All I've done is zero in, and you can see that this yield curve has definitely gone negative, and it continues to point in that direction. That is not forecasting good economic times are ahead. That is forecasting a recession. Let's switch gears now and talk about the stock and bond markets. On this screen now is a monthly candle chart for the S&P 500. So every candle represents a month in time. And if you look in the bottom left corner of the screen, you can see that this chart goes back to 2004. So This chart is color-coded to coincide with my vertical speed indicator. The VSI is a composite technical indicator. First things first, it is not predictive. I'm not making any predictions with this indicator. This is simply something that we are using to help us guide our allocations on whether or not we need to be aggressive or we need to be conservative. If you have any questions on this or how we use this, by all means, send us a message, reach out to us on our social media channels, or just email us. Our website again, hicks-associates.com. Happy to answer any questions. Think of this like a speed limit, or a better way to look at this maybe is a stoplight, a red, yellow, and green. The only reason I don't use yellow on this chart is because it doesn't show up very well. So really it's red, black, and green. So green is go, red is stop, and then the black is a cautionary tale. Now again, this VSI component is driven by 14 individual components. So there's 14 different technical indicators that I'm rolling up into one composite indicator, which I've called the VSI. So this is the month of January. So on January 1, 2022, the 100% of the individual components of the VSI were pointing to a buy signal. Fast forward to today, on December 1st, 2022, we now have 64% of the VSI components are back on a buy signal. That is good news. So while that may be good news, it doesn't mean we're out of the woods just yet. As I've already indicated earlier in the video, there are still plenty of signs pointing to a recession that is coming in the very near future. That said, this is an update to the chart that we've been looking at throughout the year. This is the stats for the S&P 500. Every line on the screen represents a year since I've been born. I was born in 1976, and you can see the bold red line is the current year. There are only 2 years, 2002 and 2008, that were worse than the current year. Having looked briefly at the current calendar year, and we're going to come back to that in just a minute, let's take a look for just a minute to see what does history suggest might be in store for 2023. So on the screen right now is a seasonality chart. It is showing the performance for the S&P 500 for every midterm election year since the S&P 500 was created. So not a lot that we can draw from this chart. There's some good years, there's some bad years, there's several flat years. But let's take a look at the year after the midterm election years. So that's what we see here. This is the S&P 500 and the performance for the S&P 500 for every year after the midterm election years. And there's a much different picture. You can see a very positive bias to the year after the midterm elections. There is one negative year out of the sample that we're looking at. So 2015 was the only year that was negative. 2011, that data is not missing. It's just it was a really flat year. And then you have 1987 and 2007. But on average, I believe the math works out to be about 15 to 16% is the average return for the S&P 500 the year after a midterm election year. So we're going to revert back and talk a little bit more about 2022. On the screen right now, you've got three lines. The S&P 500 is represented by the red line. The blue line represents the 20-year Treasury bond. And then the green line represents that 60-40 portfolio that we've talked about before in some of these videos. The 60-40 portfolio is sometimes referred to as a quote-unquote safe portfolio. Keyword there is always in quotes because there's no such thing as a safe portfolio in the stock or the bond markets, as evidenced by this year. So what we see is the S&P 500 through yesterday's close, through December 1st, S&P 500 is negative 15% for the year. The TLT, the 20-year Treasury bonds, are actually negative 27% for the year. And then that 60-40 portfolio is really struggling. And we talked about this a while back. According to Bank of America's analysts, this is the worst year since 1938, especially for that 60-40 portfolio. But in particular, I want to highlight this, the rally. There's been a rally in all three of these lines. In particular, the next thing we're going to look at is bonds. And I want to show that since that October 23rd date, the bond sectors have really rallied. Take a look at this. This is the emerging market sovereign debt. So this is emerging market debt. Since October 23rd has rallied 20%. Now we want to look at the S&P 500 again, and we'll begin to land the plane. So here on the screen is the S&P 500. This is back to a daily candle chart showing the entire year, and I've got a couple of key dates highlighted over. But what we want to ask is whether or not this participation is healthy. And see, earlier in the year, the market is coming down to this point and it's rallying, and it gets up to this point here on August, I think this is August 16th. And what I'm trying to highlight here is the fact that the S&P 500 kissed this 200-day moving average on August 16th, and that acted as resistance, and the S&P 500 got pushed back down. We created a new low, and then the market has rallied again. And then after Chairman Powell gave that raise and hold speech on November 30th, we actually broke back above the 200-day moving average. So that was then, and then the very next day, December 1st, we closed above the 200-day moving average. So the question is this rally healthy, or is the market going to push it back down? Just because the S&P 500 closed above the 200-day moving average, it doesn't mean this bear market is necessarily dead. We really need to see it remain above the 200-day moving average. So that's the question, is this rally healthy? So for that question, we're going to look at this chart. Now again, this is the same information on the top pane. The top pane is the S&P 500, and then I've got three different measures down below. This middle pane here is the percentage of stocks in the S&P 500. What is the percent of those 500 stocks that are above the 20-day moving average? And you can see right now, as of yesterday's close, 87% of the stocks in the S&P 500 are above the 200-day moving average. That's good. So then we look at the middle pane. This is the percent of stocks that are above the 50-day moving average. So right now, as of yesterday, about 91% of stocks are above the 50-day moving average. Those are both good news. But we want to zero in. I'm going to switch screens now, and we're going to look at that 200-day moving average. So again, S&P 500 is on the top, and here we have, this is the same chart as before. Here, I'll show you. 62.4% of stocks are above the 200-day moving average. That's the same information here. 62.4% of the S&P 500 as of yesterday's close is above the 200-day moving average. Okay, so that's good news. Now I want to go back and I want to look at this August 16th date. At that time, you can see the S&P 500 only had about 47% of stocks above the 200-day moving average when we kissed that 200-day moving average. So back then, when the S&P 500 is coming in to try to retake the 200-day moving average, less than 50% of the stocks were able to do it. Versus today, we actually crossed that threshold back here, and as of yesterday, we're up to about 62%. So now a lot more stocks are above the 200-day moving average. That's healthy. The last thing that we'll look at is what's called the RSI. The RSI, this is a 10-period RSI. It stands for Relative Strength Index. And I'm not going to go into a ton of detail, but generally speaking, this blue line here, we mark it at 70%, and the green line down here is 30%. And this Relative Strength Index, or RSI, generally is helping us to determine if an index or a stock is quote-unquote overbought or quote-unquote oversold. And what I want to look at again is at August 16th, when we looked at this date, the S&P 500 was indeed overbought. So it was above this 70% threshold. Now, it's important to note that this cannot be used as a timing device because stocks and indexes can remain in an overbought or oversold condition for some time. And so just because it reaches this level, it doesn't necessarily mean anything conclusive. It's more like a warning sign. And so here, when we're getting close to this 200-day moving average, the index is already overbought. That's a warning sign that this rally might not work. We might not be able to get over that line. Well, look instead at where we're at today. Where we're at today is we are still below this overbought indicator. We're still below 70 on the RSI. And so when I look at this, and we'll wrap on this thought, this to me tells me this is a relatively healthy rally. And the wind is out at our back. The other thing to remember back in August and September tend to be difficult months for the stock market. November, December, January typically are very good months for the stock market. So we have that going for us. Then we have a higher percentage of stocks that are above the 200-day moving average, and we have this index is not overbought. So what that tells us is we've got the weight of the evidence. This goes back to that VSI that we were talking about. The weight of the evidence is starting to tell us that this rally is healthy. We are not out of the woods yet because there are a lot of indicators that are still telling us that a recession is coming. Now, again, many have said, and I'm one of them, that we're already in a recession. And so if we're still forecasting, if a lot of indicators are still forecasting a recession, like that yield curve that we looked at, and we're expecting a recession, we're expecting the economic environment to get worse, not better. Well, the rally right now, it looks like the rally is healthy, but that doesn't necessarily mean that we're going to be making new all-time highs or that 2023 is going to be a fantastic year. There's still a lot of evidence to suggest that we have a tough road to hoe in the not-so-distant future. But for right now, it looks like this rally it might have some legs to it. So I hope that helps. By all means, if you have any questions, feel free to reach out to me or any member of my team. Again, our website, Hicks-Associates.com. We do hope you would follow us on Twitter if you're there. Join us on Facebook if you're there. We certainly hope that you will click that subscribe button below this video on YouTube so you get all of our weekly updates in that regard. And again, if you have any questions, feel free to reach out to us. We do have an office here in Cary, North Carolina, as well as Southern Pines, North Carolina. But again, in today's digital age, we work with clients all across the country. So again, thanks for watching, and we'll talk to you again soon.